So let's get started. Let's get started. We don't have much time left. Good morning. I know you guys probably get exhausted from the course, and there are a lot of information you need to absorb. Of course, because it's investment management. There are like one course we can offer, and suppose it can split into 3 different courses. So it will be equities, fixed income, and derivatives. And of course, if you drill down to equities, there will be a valuation, which we cover from the fundamental analysis, technical analysis. So now we cover bond, starting from last lecture. For the bond situation, I just want to recall all the critical elements. The most important elements is actually yield to maturity. So the yield, I do the reverse because I talked about when you talk about bond, you have to mention the notional value, the coupon rates, the duration, and then the credit worthiness, so the rating. And the last thing is actually the yield to maturity. We call the yield, or some people call yield to maturity, YTM. So YTM or yield is the most important thing, and then of course you have 4 other elements that when you evaluate the bond. So with these 5 critical elements, then you can assess the bond value. So compared to equities, it's different. Equities, stock, you can have so many different matrix. You can evaluate by earnings, by EBITDA, by revenues, or you can evaluate by technical indicators. But in fixed income, they're only like very, very few, only 5. With these 5 critical elements, then you can actually construct or optimize your portfolio, or even to do a bond screening, or fixed income screening. So these 5 important elements can show you like which bond is actually suitable for different investment. And I also show you 2 pretty dramatic situation of the pretty dramatic bond real life. The first one is 10 cents. Of course, I hope you guys can at least spend a couple of minutes if you really want to absorb the knowledge to drill down to the offering circular, which is the prospectus. Whenever a bond came out, or in equity, IPO, initial public offering. I mean, the bond also have initial public offering. They will always have something called offering circular. And this is something like a couple 100 pages, 300-400 pages. Even though it is like that long, but it has all the essential information that you need about the company, about the entire situation. So think about Tencent. They have quarterly earnings, they have semi-annual earnings, and they have annual reporting. So every 3 months or 6 months, they have to talk to the investor, and every time they will have earnings release, a result, or quarterly reports that you can see. It is more or less the same thing as offering circular, but offering circular will always have much more detailed information about the business, about the development. So I highly recommend you to drill down to this. And basically, if you are able to spend, let's say, 2-3 hours to study this, I can guarantee you every single bond listing will have a similar structure, because this is called the bank book for them, and they have the same structure. People or the analysts will use the same templates over and over again. The only different thing will be the content within, which means the company, the business description, the company updates. Those are the different things that you may detect. But overall, the structure is still the same. So I want you to focus on several things. The first one is the corporate structure, so see how the business line up. And the second thing is page 18. That's the credit ratings. We always have credit ratings from the credit agency. Of course, not every single bond will have a credit rating agency rating the bond. Sometimes, if it is a smaller company that they don't think they need that kind of rating, then they don't have that rating. And then, of course, if you don't have that third-party rating, that will be a disadvantage because people will not be able to see that you have something over the market. And then page 25 of the analysis segment, which is very important, risk factor. It talks about what kind of risk you will see if you invest in this company, or basically a business risk. So if you let's say down the road, when you go to work, when you want to do any industry analysis or trying to help your boss or supervisor to analyze a segment, an industry, or sub-industry, a sector, or a company or a competitor, then this will be the very, very good source because it has more than enough. So for 10 cents, it is 25 to 69. So that's 45 pages. And for Evergrande, it's almost 50 pages. So the risk factor will conclude every single thing that you guys supposed to need, a public supposed to need, need to know. And in this case, this particular section is very, very critical. If you want to evaluate anything, then you should look at that. Of course, general public will not look at that, and even sometimes analysts, investment analysts, will even skip this part, especially nowadays analysts. I mean, they I guess like 7 out of 10 will skip this particular part. And of course, another thing is use of proceeds to general purpose, page 74. It's also very important. Why do you need that capital? Why do you need this money? Do you use this for your own good, for CEO leisure, or do you use that for capital expenditures, or do you use that for rolling your previous loan? That is important. It will be well, actually, it's not your time yet, but next year when you are doing your own business, investigate your own business, then you need to tell, write out on the paper, on the report, that what is the purpose of the fundraising. So use of proceeds, very important. And then page 89, covenants. Covenants, it's a legal term. It means it's a clause, it's an agreement. It is the condition. It is the rules that you need to follow. Well, not you as an investor, but the firm has to follow. Which means if they are breaking any rules, any covenants, then you as an investor can actually sue the company. So very important, because why do you need covenants? Because it's a restriction, it's a limitation, it's a boundary. Investors said to the company that you can do XYZ or you cannot do XYZ. So it is a rule. So let's say the covenants can be something like, hey, you cannot use the money to buy XYZ, or you cannot use the money to pay the electricity bill, something like that. Of course, that will be very, very strict on the covenants. And then the last one will be the material indebtedness, just in case anything happened with if you're not able to pay debts, what's going on. So you can see for 10 cents, Deutsche Bank is the arranger, which is at the bottom. This is how you should look at that. The front page will have pretty much the major key points. The days, the company, who is foreign, it may not necessarily be the 10 cent itself. It could be some subsidiary holding, and then they'll have everything listed here. And then at the end, you will see that all the bankers get involved. The top line is always the first, like the leading bank, and then the other guys are just the arrangers, which means it's taking some agency and hopefully they can bring in some clients. And it is by alphabetical order. Usually, the ones on the left-hand side is the better bank, or the lead bank, the team leader. So you can see how it goes. Not many people will actually know this, and this particular one, Evergrande, it's a joint lead by Credit Suisse, Hong Kong, and China Merchants Securities. So nothing very important. But Evergrande, actually, there's one thing a little bit different. It is the subsidiary guarantees, page 9. It is actually not guaranteed by the parent company. It is a subsidiary guaranteed bond. So if anything fails, they just bankrupt the bankrupt the subsidiary. It won't touch to the parent. That is a big problem. Huge problem. But you know what? When they're trying to sell the bond, they don't really care. So this is where we left off from last time. I want to tell you what yield is. We only talked about yield in fixed income area. Yield in equity terms, in stock terms, that's return. So what is a return? What is a yield? Return is equity, yield is fixed income. So when we talk about return, I said, hey, 20% return, then you probably can think of stock like 10 cents or 10 cents. And if I talk about 2%, 5% return, then you can think of the Hong Kong Power or Changbang or things like that, right? Very stable company, very low risk, low return, right? Yield is the same thing. When you see a yield, really high yield, which means high return, you can pretty much assume that it's a high risk. There's no free lunch. There's no free lunch at all in the world. You can have only like high yield, high return. Can never have a high yield, high risk, but never ever high return, low risk. It's impossible. It is impossible. It won't happen in real life. So in this case, you can see US Treasury as a risk-free indicator, as a risk-free reference. Then that 4 or 5% of the Fed, which happened a few days ago, 2 days ago, when Jay Powell announced that they're going to use US is going to raise another 25 basis points. That is the risk-free. So when we have a risk-free, let's say 3%, that was last year, 3%. Yield to maturity on a risk-free US government bond, then there will be a risk premium adding on to that. And in that pink area, you can think of that pink area in terms of different types of bonds. The closer to the green zone, you can think of that as Amazon, Tencent, IBM, not Goldman Sachs now, but IBM, like the very simple Walmart, or even a company like the Changbang, I don't want to say HSBC, but it was a very stable company that is closer to the green area. But along the pink line, the pink zone, then you have a whole bunch of more and more risky company. A risk, as the higher the risk, the more the risk premium. And when you go to like the pink area, when you go like nowadays, when you go to banks like HSBC or in the US banks, Goldman Sachs, that is actually closer to the red zone. Of course, they are still not, but they're still okay. They're running okay. The ones with the red zone, that will be the First Republic Bank. If you heard of the name, I hope you heard of that name. It would be Evergrande. It would be Credit Suisse. Well, basically, Credit Suisse is already out of that zone because Credit Suisse is already default. So you know what happened? This course is so good that you can apply all kinds of market information to this course. What happened last week? So many things happened in the past 2 weeks. So if you guys remember, 2 weeks ago, I was talking about Silicon Valley Bank, SVB. The problem of the SVB was because of the fixed income that they're holding. They have the deposit dropping. On the other hand, when the bank are holding the treasuries of the US treasuries, they lose a lot of money because they're holding a long-term bond. The yield was fair to help them to make money, so they put to a longer duration, and that was a bad thing. So that they invested basically back in 2020 when the yield was low, really low, down to zero. So they have no choice. Back to 2020 when COVID happened, they have no choice. So they have to invest in some kind of the safest asset in the world, which has still have some positive number, and that is the US Treasury. So when they invest, there was 1 or 2%. And then when interest rate rises, the value drop, and they have a problem. They drop close to like 15, 20%. and then suddenly everyone wants to withdraw the money, the tech company, and that creates a huge spiral or vacuum black hole. So SVB is down, and all the bonds that they have default. So people think that is the only case. And then within a week, Credit Suisse, one of the major, well, pretty much like the second largest investment bank in Europe, the first or second in Europe, Credit Suisse. Everyone heard of Credit Suisse if you go to the finance area. That's something. So if you think about HSBC, Hong Kong is like the largest bank, then you consider Credit Suisse is the largest one in Europe. That kind of major bank basically went down water within a few days. I'm talking about just days. I'm not talking about even weeks. People start talking about Credit Suisse on Wednesday, and then on Sunday nights, I was actually watching the news. On Sunday afternoon, that was past Sunday. Sunday afternoon, I saw the news from my friends saying that people are talking about $1 billion got purchased by UBS. $1 billion. That is much less than I expected. Of course, then you have to have a relative scale, right? What was the market cap for Credit Suisse? I got to tell you, it is much larger than 1 billion. It was more than like $30 billion before. So $1 billion to buy the bank, that's very cheap. No, but UBS refused. They don't even want to pay $1 billion, and Credit Suisse doesn't even want to take that $1 billion. And then in the afternoon, I heard that it became like $2 billion offer. And then at night, it was around Hong Kong time, 3 a.m. in the morning, which is afternoon Sunday in the European zone. Then they strike a deal, $3.2 billion. So it became 1/10 or even less than 1/10 of what they had, what they were before. So it depends on what time frame. And it became a nightmare. But everything got resolved within a few days. So last Sunday, they strike a deal, and European Bank, the ECB, the European Central Bank, and also the Fed try to cover this up in a very short time. And I'm talking about just in days. The equity holders, which is the stockholders, doesn't even have they don't even have time to react. So forget about everything. And the bond for this particular company basically going from, I don't know, 50 to all the way to 0. And it was really bad. So Credit Suisse was another firm that on the fixed income side that you see. So there is you have to know what's going on with the expected and not expected, but the promised like here. But focus on the default premium and also the risk premium, like the range that you need to understand. The default premium is the it's the worst case scenario. So if you have because I'm talking about like different charts. It took me a long time, seriously, like even when I was at your age, it took me a long time to understand what is the yield spread and also the yield curve. That's two different things. This is the yield spread. So when I said yield spread, we are comparing to something, and that something is the different quality of the bonds. So if you think about like a high risk and low risk bond, as I said before last time, you have a AAA rated, which is very secure, very safe bond. A AAA nowadays, I think even for the US bond, it's going to be like a AA. I don't think there's any like AAA. But AAA is the safest one, of course. Safest bond, low yield, low risk. So the black line is a AAA, and then BAA becomes a little bit more riskier, and you can see it's the another like lighter blue line in the middle. You can see the spread in between. So the spread here, the yield spread, it means comparing the triple A to the BAA, and also you can compare it to the high yield bond, the dark blue line, which is the highest line. You can see the spread movement. One thing I want to tell you is, I got questions many times. How can you do a prediction for the market move? Then I got to tell you this: fixed income yield spread is always advanced a forward indicator. Because I got to say it's a forward indicator. Whenever you see the spread became larger, that's where you got a problem. So you check out the entire like 40 years of history, 50 years of history. Back in 1980s, I know it's a long time ago, but if you zoom into 1980s, early 1980s, you can see 0% to 4%. That's a big spread in that situation. That's a Iran-Iraq war. It's oil prices, so there's huge inflation there. So the yield spread became wider, and then it shrank and all the way close to pretty much nothing, and then boom, the tech bubble year 2000. You can see the spread became wider, and then there's a 2003 recession, mini recession, and then it came down. And then when the world became more peaceful again, and back in the global financial crisis, the yield spread like shoot up to more than 10%. That's when you see the prices. And then the second, 2012, that's not the end of the world, but that's the euro crisis. And then for the 18, I cannot remember what happened with the 2017, but people may have a wider spread because of Donald Trump. I don't know if it may happen. But if I drag this out, the current yield spread is actually wider. So people use a different thing. People can use the credit as the yield spread. There's another way you can see it's the duration yield spread, which means we are comparing a fixed income with same fixed income but with different duration. So still U.S. Treasuries, but one is the 10 years expiration 10 years. One is the 3 year. So you can see there's a difference. This one is the credit quality. The other one is the duration. So, as I said, there are 5 component components in fixed income. Well, notional value is probably like the least, and then coupon rate is probably not that useful because it's actually not market related. Like these two are not market related. You can issue a $1,000 bond or $10,000 or $200,000 bond. So that is actually not that useful, but it's spreading information. But on that, duration, credit rating, and yield, these 3 things can, because it has a lot of implication and sort of mark to market. It reflects the current market situation. So these 3 things can have the yield spread for you. So the last one is this one is the credit spread, yield spread, and this one is the duration yield spread. So 310. Some people will use 210, and I've seen people using 110. So it depends on like which duration you want to use. But let's say we stick to the 310 situation. Historical average is 1.52%, and whenever there is a yield spread, there is becomes negative, then you will see the recession is coming in. It happened in the last 20 years. When you see a negative spread, then you see the recession is coming. Negative spread back in 2006, then you see a recession coming. And now we can see actually something like back in 2019, yield spread, a mini negative, and then it up out. And actually nowadays, it is definitely another red zone game. So I hope you guys understand what's going on with the yield spread. So I'm going to talk about this really quick. There's another fixed income asset that actually creates the global financial crisis. So how come fixed income is so important? Actually, even more important than that. Because it can have so many products that can be created from this fixed income. So let me explain to you what happened. So let's say John here, this individual, a single person, he bought a house. He bought a house, and then of course he cannot pay the entire full amount. But in this case, he borrows from the bank. So the bank lends John $150,000, and the bank will not just do a single business with John, right? I mean, the bank will probably do a lot of things for many borrowers. So they assume they lend $150,000 to 100 different people. So when the bank collect all these mortgage, all these loans, they combine it and then send it to another bank. So let's say this one will be HSBC, and then they send it to Goldman Sachs. Goldman Sachs will have a team to package the entire thing. What happened? Once they package the entire thing, and then they resell it to investor. So what is the good thing about this? Because HSBC, the first bank, will lend the money to John, will take their hands out of the loan. They no longer hold the loan. They can just transfer the loan to Goldman Sachs, which eventually transfer to the investor. The good thing about the HSBC is they take off the risk, and if they miss the payment, it's not my concern, because your guarantee is not responsible. It will be the investor who suffer, not the bank suffer, but the investor suffer. John forget to pay something, it will be the investor suffer, right? What about Goldman Sachs right here? Of course, they are always the agent. This is how they make the money. They never ever take any risk. They absorb, well, pretty much they are just a processing processing factory. They process all these mortgage pool, combining, we call it pool, like a swimming pool. They combine these pool and they transfer this pool and make it the same product, and they sell it to the investors. So what happened? Sometimes John may borrow $150,000. Peter may borrow $200,000, and then Will may borrow another $300,000. It's not uniform, right? It is like the price will fluctuate. The borrowing amount will fluctuate. Even the location. Maybe let's say Hong Kong. John may came from Kwintong. Peter may came from Ho Chi Minh, and I may come from Hong Kong Island. And so it could be different location, but different location may have a different risk perimeter. Sometimes people living in Hong Kong Island is more risky, riskier. In this case, then how can you transfer the risk to individual investors? No, you cannot. But the bank, the Goldman Sachs, they can actually combine all these funds and issue uniform securities to the investors. So each investor will have a diversified portfolio, which is good for them, because I can accumulate all these individual borrower from different places. I can diversify myself. And another good thing for these investors is they don't need to lend you $150,000. They can lend you $1,000 a piece, $1,000 a piece, and they just pay a very minimum. Because for one individual borrower, you may have like 100 different investors. So for investor, you can actually select the size you want. You can select, I can buy 10 shares, I can buy 100 shares, but I can also buy 1 share. So this is good for the investor type. Goldman Sachs make the money because he's processing the fees, so he will capture maybe 50 basis points of 0.5% processing fee. But HSBC, yes, they lend you the money. They collect all the application fees and also the advisory fees of things like that, administrative fees. HSBC is happy, Goldman Sachs is happy, investor is happy, and John is happy. Everyone is happy, right? Yes. This is actually a very ideal case. This is called the asset-backed securities, ABS, or if I change this to asset-backed, that's a more general term. This specific one is called mortgage-backed securities, so MBS. So when you heard of Fong Tai Zai Kyun, so that is the the MBS, this is all about everything is all about the fixed income, because you have a very stable, predictable cash flow coming from the borrower, sending the money to the bank, which is going to the Goldman Sachs and then to the investor. Every single month, they will have to collect the cash, and every 6 months, the investor will get the blueprint. So this is a very good system, very good structure. What happened is this. This is called the MBS, or mortgage, or another term is called mortgage pool, mortgage pool MP. Why there is a huge financial engineering that can actually go into this particular segment? Because if you have a really stable cash flow, a predictable cash flow, then you can actually make a lot of create a lot of profits. Here you create something called the mortgage-backed securities MBS. What if, because people become smart, these investors, you assume they are uniform, they have the same investment expectation, they have the same, they're facing the same risk. But what if this particular group of investors consists of some wealthy individual, someone who actually may want to take more risk and then higher return, and within this group there have to be some investors who want to have a lower return, but I want a safer return. So in this case, then the banker, Goldman Sachs, what do? They will think of, hey, if the market needs it, I create that. If you need it, I'll push that. I'll give it to you. So what happened was, that was back 50 years ago, 40, 50 years ago. They create something called through the MBS securities. And this MBS securities very similar, but then instead of selling the individual uniform bond, they sell it in terms of tranche, TRANCH, tranches. There's a French word. But basically, it's just a different categories. So they classify the bond. They chop up this mortgage pool here, and then they chop it up equally, and then the highest one, which is, let's say, I want to get a AAA rating. AAA rating, then I'll create a tranche that will be really safe. They have they may have only like 2% coupon rate, but then they will be like very secure. And then they will create something like a double A, single A, triple B, or even single B. They may create something like a double B tranche. Why would they do that? Because in that double B tranche, they pay a higher interest to attract the investor. And at the same time, of course, it's higher risk. So they're not lying to the investors. They would tell, hey, you got a high risk, and of course, high risk with high return. You get a coupon, you may hit up to 6%, 8%. So that is good. That is good, because some investors say, hey, I want 8% return. I don't think you're going to go default. Because all these borrowers are very nice people, and they will pay the mortgage. So it is up to you if you want to do the analysis, see if this pool is actually good. So what happened is with this, then from a uniform MBS, then you create different types of tranches MBS, and with that, then there's actually another crazy engineering going on. So that's I pulled this out from the IMF, International Monetary Fund. They try to explain to you what happened with the global financial crisis. So you can see all these black houses. The black is good. So when you have on the left hand side, you can see the first combination, the first pool become the residential mortgage-backed securities, which is fixed income securities. Then they cut it out into tranches. When they pay the mortgages, then you have the water, sufficient water, enough water to actually fill all the coupon payment. That's good. Look at the second one. This one, the top line right here. You get one red house. What does that mean? It means that red house cannot pay the mortgage, so it goes default. So you receive less water. You can see in the pool, the triple A tranche is still getting all the water, but then the double B minus is getting like half tank. So they got suffered. That's a problem. Look at the third one, is still fine, but then the fourth one. You can see the fourth one, which is on far right hand side. 4 red houses. What does that mean? It means that none of the bottom tranches will get any water at all because they cannot even fill up the first tranche triple A. So that becomes a bigger and bigger problem. And you can see if you have 3 red houses, 4 red houses, 5 red houses, you can, the fewer houses, the more red houses you have, the harder you can fill up. Even the triple A get a problem. So in this case, what happened? You go default. Goldman Sachs, they're genius. They said, hey, why don't we combine all these 7 different residential mortgage-backed securities, and let's create another one called this for the credit CDO, collateralized debt obligation, CDOs. It is another derivatives of fixed income. And then when you create a CDOs, they also sell it to different tranches. So they try to avoid, push the problem by combining them together, sell it to someone else, and someone, hey, they don't care and they keep buying. And when one CDO fails, let's combine all the CDOs that create a CDO2. And you can see what you have when you are investors of CDO2, the situation magnified and become worse and worse day by day. And at the end, when the bubble burst, that was back in 2008, several investment banks got failed. So Lehman Brothers, Merrill Lynch, all these are actually much better than what you see like the HSBC bank. Those guys are like the legend. The legends are the US legends. Everyone wants to get in. It was horrible situation at that time. So what happened last week? Credit Suisse, the European bank, failed. People talk about and try to comparing from time to time. As I said, I recommend a lot of textbook to you and also movies. Unfortunately, I don't have time to do that. So why don't you click? I think the link is still there, but they explain what CDO means. And it is actually a pretty good summary because you may not understand what I just said, but if you watch that movie, the core video here, the chef, he is actually very good. That's a very good explanation. So when you have a bank, then you have there are different terms and a different tranches. So who will get first? This will be the what I meant by get first is, let's say if the bank went bankrupt, then who will get whatever first? And it turns out that this slide was pretty useful because Credit Suisse equity shareholders thought they can actually get something. No, they get nothing because equity holder residual tranche who pretty much got wiped out. And not only this, there's actually another debts that I'm going to mention a bit also got wiped out, and people have no clue on what's going on. So senior tranche usually will get something. You will get something if you're a triple-A rated, and then mezzanine is the one in the middle, investment grade rating. But still, if the bank went down to the bottom of the sea, then pretty much like that you get nothing. This is actually good. This one right here, big shot again. Front point versus S&P. Standard & Poor, not very similar to the one S&P 500, but it's pretty much the same company. It's another division. What happened was Front Point is a very famous hedge fund in the U.S. and they back in 2007 they were questioning these rating agencies. As I said, it's a big problem. It happened again this week. Standard, actually it's Moody's. So Standard & Poor is actually one of them. Moody's is another rating agency, and Fitch is a third rating agency. Moody's downgrade First Republic Bank, so which is the U.S. bank that got suffered. So Silicon Valley Bank, it was the first one. And the first Republican bank was the second one that people talked about like all these days, all these times, and they thought that it's going to go south. The stock tanked by almost like 60%, and then last week, after it tanked by like 60%, Moody's issued a report. They downgraded the bond. That is actually so slow. I mean, the reaction time is it's actually incredible. So we are talking about like this front point in S&P. So whenever you see S&P doing any adjustment, it's always up, always after the fact. It's pretty much like the market moves already. People draw the money out already, and everyone got settled down, and then they downgrade the stock, so downgrade the bond. So it was slow. But watch out this particular movie because there's an implication when they saw that lady from S&P. The lady was wearing sunglasses, and they said that hey, the lady, it was actually trying to make a joke that these guys, they don't care about the credit rating, they just care about the monies that they can earn. So what happened is this is, I hope you guys understand the triangle relationship. It is the company, the one who needs to raise the money from the bond, from the debt market, from the capital market. It is the company paying the credit rating agency of very heavy fee, very expensive fees to have their bond rated. So it is like I am paying, let's say I'm paying a third-party agency to give me a good score. Something like that. They always said, hey, it's independent, but hey, who knows like what's the incentive behind? So I pay their salaries. Wall Street, this is the Olympic competitors, participants, and they pay the judges, the rating agents. It doesn't matter how bad the bond, how bad the performance is, they will always be good. So this is how they were mocking the Senate. And so another side bets for fixed income is credit default swap, CDS. It's another indicator, very, very good. It's also fixed income. They're doing a swap. So basically you are entering into agreement. Something happened or something may not happen. And they are buying this and selling this. So at that point of time, 2008, it happened, and this happened also in 2 weeks ago. Deutsche Bank actually stopped buying the CDS because someone actually stopped selling the CDS to investors regarding Credit Suisse bond. They stopped selling that because they know they're going to lose a lot of money. So they stopped selling. So that's Deutsche Bank about on Credit Suisse. So you can see the situation became extremely sensitive at that time. So CDS, credit default swap, and also credit default swap can be on different things. Can be on a company, can be on a fixed income, on a bond, or can be on a country. So this is sovereign CDS. So you can see Greece was spiked up to the highest one, if you guys remember the Euro crisis. And nowadays, of course, like the bank CDS will have a much higher and this one, I think, is a CDS for different countries. It was actually last year. So Colombia is always the highest one, and then US. I want to drag the one side that you can see. Developed country usually have a lower CDS, and then this is the another residential mortgage. This is the part that I want to tell you. So you may have heard of people talking about like this with COCO bond, convertible, a contingent convertible bond, or conditional convertible bond. It's a bond, but it is this bond that never expires. It's a perpetuity bond. So people talk about this COCO bond, but it has been alive for like I don't know 10 at least 15 years. Especially the name COCO bond, perpetuity bond, it has been out there for like a long time. So what happened with this AT1 AT1 bond? Same, it's the same interchangeable name. Additional tier one bond. When you see the bond, the name bond, they say, hey, this should be very, very secure. No, not necessary. Last week, Credit Suisse AT1 bond is all got wiped out. So everything down to zero. They will not, they promise they will not pay anything to that bond, to all these bondholders. So this is one type of perpetuity bond that becomes very, very popular, because last time I think I said that it is hard to find perpetuity bond, but now this count in Candy. So it was this is an ETF portfolio, by the way. You can actually invest even now AT1 L10. And back in the COVID situation, it was trading around 24 and then boom down to like 19. And it happened again this time. So anyone who wants to make some quick money, quick return, I guess you can buy not of course not in the next 2 weeks, but probably in the next year. This guy probably will go back up. I don't know, 20 now it's 20, 24. I think it should be all right. Because hey, you got a central bank, all the central banks in the world is trying to support this. And by the way, I checked in I looked into the holdings. So if you look at the Invesco AT1 ETF bond, look into the holdings, they're holding some pretty I think comfortable, like pretty stable banks at AT1. So it is good. If there's any rebound, 20 to 24, that's a 25% return. So that's a good thing. And by the way, this ETF, so you can treat that as a stock to buy, and it has a basket of bonds. So let's see what happened. All right, let's see what happened in by April. So now it's March 24th. And there's a description here. So any particular question? Any particular question? Okay, let's take a short break first, and we'll be back at 9:55, and we will continue for the last session of fixed income. Wow. Damn. 不同的房子代表不同的borrow，就贷款的人，他有可能可能现在没问题，那个时间，就是那个人有一个人可能就没有能力去还偿还那个，比方说你贷款的时候是每个月会有一个when you borrow mortgage，需要每个月要还钱，所以呢，比如说那个 the second one 没有能力去还，一个 fail 其实是没有什么问题的，可能最后的一个最底的一个同事就可能拿不到，原因是他给不了，所以你最后都拿不到。就是如果当那个最有问题的那个时候，4个还不了的话，那就很多的投资者拿不到，所以那个时候就到那个08年的时候，其实整个怎么说的那个 residential market 在美国的一个那个房地产的一个生意，其实很多人 在那个利率很低的时候买了很多楼，可是他没有能力。比方说一个人可能买了3个4个不同的屋子房子，可是他有一个有3个4个不同的一个贷款，3个4个不同贷款，他有可能有2个3个已经还不了，还不了的话就变成一个非常大的。其实国内也是一样的。
这个还不了会导致这个
他还不了的话，没办法是亏钱。可是你亏钱没问题，可是如果你是一个投资银行，那么这怎么办呢？我会了这个整理好一个你所有问题，就是推出整个一个 CDO 另外一个产品，所以那个是另外一个产品，那个本身是一个产品，那个是统一律型的产品，那个是第二类的那个产品，跟那个产品不一样，
是当他
那个是 MBS，那个是 CDO，
这里就是
对对，就是将所有的一个资产啊加起来，然后就是变成为一个 CDO，将所有的 MBS 1、2、3、4、5是加起来变成为一个CDO。原因是因为那些产品没有人去买，没有人去卖。他买的时候，我就说，哎，没问题了，我就将那个7个产品加起来就变成了 CDO。变成了 CDO 的时候，你会看懂那个300页、400页的那个 offering circle，你不会看了，你不会看的时候，说哎，应该没问题的，应该就是没问题。
这个单个的 MBS 都没人买，为什么如此会起来我呢
repackage， 整个他们 repackage 另外一个产品，就是说，哎，那些之前的问题哪里看一下，如果单一的一个问题，你可能就一个付不了，你真的是问题。整个图看的时候，你只有3%、5%就可能就还不了钱，这整个来看就可能比较小问题，所以它就推出来就是还有一个啊当然呢，那些 C 就那些 U 的开始变得比较高，可是它没问题啊，Goldman Sachs 它不是那个拿 它将那所有 risk 转给你的，所以那个 U 肯定会高很多。Triple A 的可能就比那个 Triple A 的高一点。对对对对，对对对，
是不是那样？那个，这里就是说，我股的话就是三点了，一开始不可能，现在我就可能是一部分固定收益，然后一部分可能就是那个商品，然后还有一部分是股票，然后选好平底嘛，然后选好平的时候，就是关于股票的话，就是可能投资比较清楚，一部分就是说对应是股票就是进行买的这个，然后就是当它升的时候，就把它卖了，跌的时候就是看它好的
对啊对，那就是对，你可以这样做，你可以这样做。有些同学就不一定沽空，他可能就直接 long only，就买一只股票长期的持有，不需要沽空。沽空是啊、一个 option，一个选择，就是说，哎，你看见一家公司可能都是股价非常高比方说那个1292，那我觉得哎这个挺高，17块的时候是挺高，我就先沽空，然后就是晚一点再买，也可以有个选择。之前很多人普遍的人就传统就是哎我要先 buy，然后就 sell。现在我给你个选择，就是哎你可以 sell 之后才 buy，没问题。没问题，那可以先 sell，然后是 buy，所以那个是 sell to you，一个是个选择，就是那些是想选择哪一个先做，
还有什么其他投资就是
不同的行业，你可以放在那个科技股、能源新能源或者是什么板块也行，所以一个是 up to you，一个是全都是你觉得。有些同学，哎呀，我觉得有一个同学就是集中在那个 一些小型的股票，就是非常1块2块
低的，就是
对，低的时候
买的都
对啊，他每一天交易40、50币交易，每一天赚很多钱。那当然了，那个在那个现实的时候是做不了，原因是因为没有那么大的这交易量，他每一笔是两个 million 去放上去，整天的交易只有10多万、1万、2万，看你怎么在现实的真实的一个世界做不了。可是他要解释一个是问题，他要知道为什么会赚钱那个是挺难的。如果他真的他可以赚钱，可是不知道怎么去赚钱，写不出来的那个 report 就有点麻烦。所以你看看那个，所以很多不同的，
好学，可以
那也可以很多不同的方法，你可以看 data，也可以看一些继续性的那个是indicator，technical indicator。RSI 啊，Golden Japan 啊，MACD 啊也行，或者是你说可以选择一些基本的分析研究一家公司的一个营运的一些能力管理的能力也可以这样说，也可以这样看，是那个是很信任的一个问题。那个是很难，就是你说，你我觉得你问那个问题就是，为什么 E equals MC square？E 等于一个 MC square。你知道那个是一个物理的理论，E 等于 MC square，都不知道。
关系。
对啊，那很简单的一个 formula，可是在里面呢是背后很多很信任的一些机制。所以如果要回答你的问题，我也尽能力就是将所有的一些 PowerPoint 要看一遍，那个已经是最好的上 u 了，最好的上 u 所以
就是还有其他推荐的
ETF 就是刚才跟你讲的一个 AT1 也是一样，AT1 就是集中在那个COCO bond 的一些债券的一个投资很多不同的 ETF 可能 cover 不同的行业，有 cover 不同的行业或者是不同的策略，有些 ETF 是不同的策略比方说它可能做一些merger arbitrage或者是long only 或者 style investment。style investment 就是有些说，我比较保守的 conservative 也有，比较非常 aggressive 也有。有些 ETF 就是说，我是一个 ETF 是对于一个 futures 来做的，可是3倍多比方说 market 涨了1%，它可以 ETF 回报是3%。所以有很多不同类型的 ETF，你要问一个问题，我怎么去投资？哇，那个是非常呃简单的问题，可是要回答这个问题是非常复杂。所以你要怎么投资？我要知道是你的风险的程度可以承受多少的风险程度，你要多少基金还有一个你的目的是什么？你目的是一个收息的 dividend，或者是你要赚最短时间赚最多的钱，这两个不同的概念你说最短的时间赚最多钱没问题你知道你的风险要多大？你的目的是比方说一年15%的回报，我告诉你15%的回报，你只需要有一个承受30%的风险，你承受了。有些客人跟我说，老板跟我说，我要25%的 return，可是风险只有你，没有一些 freelance，也不可能，也不可能。
如果有那些可靠的利好消息的话，然后我就长期做会不会？这可以先决定。
那当然的可以让你首先呢，你有一个消息，为什么你觉得那个看不好？为什么看不好呢？你有一个消息的时候，你就会写出来。当然的可以这样做这样好。你看。 Huh? Oh, sorry. Legal fixed income, fixed income. It's a very complicated, very sophisticated topic. As I said, it took me like a one semester whole course to learn fixed income and just the basic fixed income. This one, it took me like one course to learn just from the past lecture. And then there's another lecture for another fixed income, advanced fixed income for this particular lecture. And I only have like 45 minutes to cover this. So this is all pretty much impossible. But I will try my best to do it. I will try my best to give you some key terms that you probably have to know. But before that, let me go over some course logistics with you guys. So next week, there will be ICA 3, and the ICA 3 will cover fixed income. And as usual, as always, the first hour will be conducted with Eva, and Eva will go through the entire ICA review. So all this, and so listen carefully, and I will try to reduce again. Now I will try to reduce my words, not your words. As I said, hey, you just need the 20 words to answer the questions, right? I realize that hey, it may not be your words that you need. It probably will be like my words. I will try to shorten my words and try to make things clear. And so I'll try to do that. So next week, the ICA 3 will be for the fixed income. So in the last two sessions, everything. Again, I'm not asking you to do a lot of calculation, but I hope you guys understand the concept. The concept is much more important than the calculation itself. After next week, hopefully that will also be a review with the final exam, well, not the final exam, but the quiz. So people probably will concern about the quiz, and you will have time. Most likely you will have 2 recorded sessions, so at least 4 hours to cover the quiz. People will do that for you for the last 2 recorded sessions. So make sure you attend those recorded sessions. And after that, well, probably like during those 2 recorded sessions, she will go over all the necessary questions with you. Again, the quiz itself will be very similar to the concept you have with the ICAs. And we'll try to avoid all the difficult parts, all the complication. So it will be a simplified version. And another thing is the quiz will be on a Friday, so that will be on April 14th. Is it April 14th? That's a Friday, right? April 14th. So it will be in class. So that will be the first time it's 60 something 60 students in class. So that will be the deal. And afterwards there will be a assignment 2 deal. And for the assignment 2, don't worry about that. I will have a separate session and to discuss with you, probably a night session over Zoom. And if you have any questions, you can ask me at that time. So that will be hopefully before the Easter holiday. Or before or after. But I hope I don't want to disturb you from the quiz. So this is how we're going to proceed. And in the quiz, you will encounter questions very simple with portfolio statistics. And then definitely will be equities and then fixed income, and then one will be from the options. But options, again, a very simple high level questions. So I just want to touch upon like different asset class with you. So that's pretty much it. Nothing very good. stand out from unusual. So term structure. Again, gotta say, I cover a lot more than you need for the quiz. So if you ask, hey, do I need to study all the PowerPoint slides? The answer is no. You don't need to study every single one of them. And especially the ones I said, hey, this is totally out of syllabus. Then it is actually for your information, because I know some of you are actually eager to learn for this investment. So I give you more than you need. And sometimes the matter is actually too hard for you if you don't have some kind of background. So I'm going to just give the slides to you, give you some keywords, and you study on your own. Probably not be good. Especially term structure. It is getting like crazy and crazy. So what is the term structure of interest rates? And then you ask me, how come there are so many different names for it? But think about this. As I said, there are 5 critical elements, and 2 of them, notional value, principal, which is principal, coupon rates, are pretty much useless. But the last 3, credit rating, maturity, and also the yield to maturity. Those 3 elements are very, very important. And these 3 elements basically construct different graphs, and that's a yield spread, and term structure of interest rates is the same thing. It's pretty much the same thing. It is the yield. You can say the term structure of interest rate is a yield curve. Let me show that to you. What you need. So relationship between the yield and maturity may be shown graphically on the yield curve, and we explain to you what yield curve is. So there are different types of yield curve. So there would be a flat one back in 2006 when everything was so good, flat one, and then 2012 when markets became stable, like going from the bottom towards the better economy. There you can see upward trending slope. And then back in 2000, right after September 11, you will see an inverted yield curve, IYC. So this is one thing you got to learn. Inverted yield curve. And then there's a song shape. So what happened is September 11. So you guys, I'm not sure you guys are even born yet, but September 11 was the one when let's say that will not happen, but let's say Hong Kong IFC got hit by aeroplane, and that's a terrorist attack. It happened in New York, not in Hong Kong, but it happened in New York, and it was a bad day. So in that case, people speculate, hey, tech bubble is already worse, and September 11th is even worse. It will bring down the entire economy. U.S. stock market was the first time shut down for close to 2 weeks in history. It never happened. By the way, these Americans, they're really hardworking. They will never ever have a stock market that was shut down for more than 3 days. First time was actually back in 2000, year 2000. The second time was when they have ex-president, President Ford, passed away, and they have coincidentally it was actually on the US. So in that case, they shut down the stock market, closed the stock market on the 3rd. So it became like a 4-day straight holiday. So that was the first time. But here, you see there's a inverted yield curve. Very important. Why? Because nowadays you see an inverted yield curve as we speak. Really bad. That means it's a recession coming in, and it is inevitable. And then the next one is hump yield curve. But you never see a smiling yield curve. Hump yield curve is kind of weird. But back in 1989, October 4th, so that was actually I can't remember what happened except the date that the June 4th was the ones when there's a very unstable situation in China. But other than that, that's almost happening. I think support back then. But anyway, this is the yield curve now. The blue one, even though it's kind of stretched out, but it is also it is considered inverted yield curve, because in a typical yield curve, you see when you were back in last year and also the year before, it's actually upward trending. But nowadays it's actually downward trending. I think it's better already, because if you check the yield curve 2 weeks ago, it is definitely a inverted yield curve. So it is better. So go to gurufocus.com. That's a website that gives you all different kinds of yield curve. It is a pretty good website. And so what is the yield curve here? A lot of mathematics. So when we call the yield curve, it is, you can see this is the yield to maturity at different from different maturity, different expiration. So let's see for this particular blue point, but all the way towards the right. This one says it's 2.75% for 30-year bond right now. So the yield to maturity for 30-year bond, 2.75. For the 3 months, it's let's say 4.50. So the current 3 months is actually 4.50. 30-year is actually 2.75. Does that make sense? Yeah, it actually sometimes it can. It means the future is more secure than far away. I don't know. The current is actually more secure than the far away future, which means that investor or the business owner or even the government probably can control that. But the business owners, the people, and also the market will believe that, hey, give me the cash now, it's better than the cash like 30 years from now. I'm not going to invest and go. The phenomenon is changes from last year. Last year, 2 years ago, you would see a typical yield curve. So this is called the yield curve or term structure. Term, which means a different term, and then this is structure. So this is the treasury yield curve, and this is the typical yield curve and inverted yield curve. So yield curve is about the yield against the maturity. If you remember the previous slide, the previous file, we have the yield spread from different maturity, from different credits, from different well, I could just do different maturity and different credits. And this one is actually from different duration, different maturity as well. But then it will be the same product. The other ones, it can be by different matrix. So you can see there are several different matrices, and different matrices will give you different names. So I put that in words. If you there's actually another word called a bond stripping. So when you do a bond stripping and bond reconstitution, so chop it off and then combine it. So that's what I mean. Slice it and put it back together. And mathematically, how can you do what can you do? So in this case, you will have, let's say, 4 different bonds. One is 1 year, 2 year, 3 year, 4 years, right? And then you will have a different yield maturity because people will set the price by this yield maturity again is set by the market, not by the government, not by the company, but by the market, but by people buying and selling, demand supply. So when you have the yield to maturity, then you can calculate what the price is, and with the price, you can see a different period will have different interest rate to equal all the prices, right? So with this, this particular table will basically slice all the 4, let's say the 4 year into 4 different years. And once you have the 4 different years, then you will be able to construct the interest rate at 5%, 6%, and 7%. And so you can see how that goes. I know this is complicated, so I'm not going to go deep into that. And then there are 2 types of yield curve. One is the pure yield curve, and basically you do the strip it and then 0 curve points. Then the other one is the ones when you are selling at the near par value. So you can see a bond can sell at par. Par means at notional value, which is 100%, 100, or the discount of 3. So on the run, On the run, it means that there's a lot of different terms in fixed income. So when you see on the run, that means it is actually very hot in the market. Fixed income is different from equity, by the way. When you buy, sell fixed income, usually the largest product, the most active moment will be during the IPOs. Once the IPOs is done, 3 months later, you want to buy it? No, there is no market at all. For instance, if you want to buy the silver bond in Hong Kong, or green bond in Hong Kong, or inflation I bond in Hong Kong, yeah, you want to do that in the first week. If you want to sell it, you want to sell it in the first week. Because after then, let's say a month later, 2 months later, you will not be able to sell it, or you are able to sell it, but then you will incur a large transaction cost, and which will be buried into the bond price. So there is no commission or no fees when you're executing the bond, because everything is buried in the bid-ask price, just like for foreign exchange. When you do a foreign exchange transaction, do you need to pay a commission? No, you don't need to pay a commission, because the bid-ask price is already built in the commission. The broker will keep telling you, hey, just trying to do the buy sell, because that bid-ask is what his salary is. Equities, different. Equities, you have to pay a commission. So in that case, it's more pure. For the bid-ask spread for equities, it is basically purely from the demand supply from the market. But for fixed income and for foreign exchange, that bid-ask is actually including the demand supply and also the incentives schedule for the brokers. So that's another layer. Again, on the run, it means the ones that is actually selling and are hotter in the market. And so there are something called arbitrage. It's possible that you can see if in real life there's no arbitrage, then you're able to apply or imply what is the interest rate for a particular bond. So there are considered two. So there are two of them. Two-year bond strategies. The first one is to buy the 2-year zero, offering a 2-year yield to maturity of 6% and hold it until maturity. So in this case, the face value is $1,000. You purchase today. You just need to pay $890. So 2-year zero means it's zero. There's no coupon at all. Simple calculation, right? Very good for a quiz, right? You don't need to memorize anything. So 2-year zero. You just need to use the face value divided by the yield to maturity, the rate, and you get $890, which means that you pay $890, and you pay that, and then 2 years later, without getting any cash inflow whatsoever, then you get $1,000 back, and the return, the implied return, 6%. That's easy. So in this case, the 2-year growth factor will be 12.36%. The growth factor, because you pay this and then you get this. So invest the same. The second one is invest the same $890 for 1-year zero coupon bond. So 1-year zero coupon bond with the yield to maturity is 5%, and upon maturity, reinvest the proceeds in another 1-year bond. What will happen? 1-year zero bond. So this is the calculation. Profit. So let's say the first one will be a 2-year investment, $890. You invest for 2 years in no cash flow, and then at the end you get $1,000. And then the second choice is to do 1-year investment, 5%. Then you will get $934.50. And then for the entire another year of investment, then it will be $934.50 times 1 plus R, right? That will get you the future value. Of course, if there is no arbitrage, you have to equal that to $1,000, right? Then what is the implied interest rate or yield to maturity? Again, I always change the interest rate yield to maturity. That means you have to pay. You have to invest in 7.01% return in that year in order to get $1,000. That which also equal to this. If you believe this is complicated, imagine like all the traders around the world trying to spot this, trying to make this absolutely no gain for everyone. they will mark the price, they will mark the yield to maturity 701. To be precise, not 702, not 70, not 700, but 701. Make sure that no one can make a gain. Imagine if you can make just a 0.01, just 1 basis point gain. Imagine I dump like $10 billion in that. I make a lot of return. This is secure. Right? So this is how you can use this is also what we call the bond stripping and bond reconstitution, which means you will be able to calculate what is the forward rate 1 year after. So I know it is getting even crazier when I talk about spot rate, forward rate, 1 year spot, 2 year spot, and there are all kinds of crazy things. I'm not sure you learned that from your 280, but it can be complicated. So 1 year spot rate is 5%. 1 year forward rate F is indeed the 7.1%. And the 2 year spot rate is 6%. So there's a lot of different terms. And trust me, if you are getting into finance industry and if you're getting into fixed income industries, particularly in this field, you have to know all these, and pretty much you can smell if there is something wrong. You know that the total is 6%. The first period is 5%. Then the second period has to be higher than 6%. You see, this is the logic. In the quiz, will I ask you to calculate that? Most likely not, but you can actually interpret from here, right? If I said the 2 year zero, annualized is 6%. First year is 5. What do you think the second year? Then I hope your answer is going to give me a 7% or anything higher than 6%. So in this case, I will draw a chart. Maybe something like this. Total is 6%. This one is 5%. I hope your answer is not going to be 1% here, which I imagine like there will be a lot of students going to want. Okay, this lecture is recorded, but I don't think many will replay this. And I say that, and even it's here, so she will actually cover this. 5% in the first period, 6% in total. You don't give me 1% in the second year. 5 plus 7 is equal to 6. Or maybe I should say like 2 years, 6, that's close to 12%. And 12% minus 5 is always 7%. So this is the logic side. I don't want to complicate you with the compounding thing, but this is how you should look at this fixed income.
How can you make sure after 1 year the coupon rate go high?
No, because you can calculate this. If let's say this is 701, right? If you pay 6%, let's say if this one the second year investment, if this R2 is 6%, then you think about yourself. I won't tell you the answer, but you think about that. If someone offers you 6%, then your next question is how can you make money? Because you can definitely make money. Think about this. You can invest here, it gets $1,000, and you in here you just need to pay 6%, and you just need to pay 6% for whatever future amount. That will be like, let's say $990. So what are you going to do? You borrow this, you short this, and then you invest in here. And of course you can lay down the entire plan. But yes, go ahead and check it. What if this R2 is 8%? How can you make money? What if this R2 is 6%? How can you make money? I can tell you that if it is not 701 to be precise, you can always make money. You just need to reverse all the trades. So in finance, this is the interesting part. You can make money with it doesn't matter what kind of thing that is, as long as you spot there's inequality here, non-equilibrium, then you can actually make money. Of course, best way to do is using the computer technology to tell you to do all the calculation, and to try out yourself. And I highly encourage you to do so. So I give you more than you need. I know it's going to explode your mind. It's a spot rate. SPOT, it means from now, or not necessarily from now, but it is the current rate for that. And forward rate, when I say forward rate, it means like the period afterwards. And there is actually another term called the short rate. And I hope in this chart, in this particular chart, will give you all the terms necessary. So when I said 1 year forward rate, it means 1 year from now, the forward rate 1 year from now. And the short rate, it means different periods. So you can say that, hey, there is a relationship between the short rate and also forward rate. Yes. And also short rate, forward rate, and spot rate. There is always relationship. It depends on how you quote the term. And that is again, I'm not going to trick you in the exam, but this particular chart, it looks easy. Yes, there will be a lot of but spot rate and short rate. So in this case, spot rate, it's always the spot rate from now to time period X. So it's a spot rate for you. But I can say a spot rate 1 year from now, or I can say the spot rate right now. So it depends on the English. I don't want to play with the words. So there are different terms for that, and there's always a relationship. So let's move on from this rate. I know it confused quite a few people, but just remember there's always a forward rate and spot rate and short rate, and there's terms for that. Again, for the holding period return in fixed income, they always have that. As you know, when you do the bond calculation, all the coupon discount to the present, and then the principal value discount to the present, and that will be the bond value. In fixed income, it's the same. All the incomes plus the annual period, all the return will be the holding period return. That will be the same thing for the bond. And this one is the the reason I include this is it's essential, but it will be again will blow up your mind as well. When people say 2 year into 3 year rates, it means 2 years to start building this, and then after 2 years, and then the 3 year loan. And then 3 year into 1 year. That means a 3 year to start building this, and then for 1 year loan. And I list out here. This formula is actually not a crazy formula. It will be the same formula as you deposit $100, 10% interest rate. 1 year later, you'll get 110. That is the same thing. The only thing is it compounded, and then we change it to a more flexible use in this formula. So nothing important. Again, this one I'm not going to maybe graphically I can explain to you. So imagine this: the 3 year maturity is 7%, rate for 4 year maturity is 8%. So from 3 year to 4 year, the rate is going from 7% to 8%. So what is the gap in between? So you can see it is going to be around 7% going up to 8%. That's 1% increase. And when 1% increase, but in terms of 1% over 7%, that will be close to 10% increase. So in this case, you can imagine like in between there will be 11% for that. This formula will be interpreted by this particular formula. And this formula, 11%, is exactly the ones that you see from this short rate right here. So the one thing you understand this clearly is if you actually go into the calculation for all of this, so 5%, 6%, 7%, 8%, and then recalculate all these short rates yourself. Once you're able to get these short rates, then you will be able to understand this particular equation. So this 11.06, it's right here. So 11.06 right here, 4 year is exactly 1.2. So you can calculate all these short rates with this graph. So if you understand the logic for 2 years, so 1 year, the first year, the second year, if you understand that 5%, 7%, how come it's 6% here? 6% is 6% annual number. It is not 6% total, but 6% for first year, 6% for second year. So in this case, you can approximate the return. 6% equals to 12% total. That's 5 plus 7. 7%, that's let's say 3 years, 21%. 5 plus 7 plus 9, that's 21%. This is how you should read it. So 8% for 4 years, that's 32%, right? 32%, you add all these up, that's about 30%. This is how the compound and the simple rates on that. Do you need a calculator to calculate this? Now you don't, right? So in the quiz, if I ask this question, so we'll say that I cover this in lecture, and you will cover this in the quiz. Like quiz. So once you understand the short rates and then the spot rates, then the forward rates will be easy to understand. So I'm not going to go into that, but I will talk about this rate again, interest rate. You have the this kind of structure, the yield curve. This one is an upward trending yield curve, YC, and that is the typical, this normal. And people will try to understand this, and this is why I explain to you what I'm going to explain to you. You have the years to maturity. So this chart is exactly the one I showed you 10 slides ago. We have an inverted yield curve, right? But now let's talk about the normal one. When you have a yield curve, why it is upward sloping? Because first of all, it composed of 2 different theories. The first one is the expectation theory, the yield curve. So short-term interest rates are expected to remain constant for forever, and then there will be a liquidity premium, or something, or another people call a preferred habitat. So preferred habitat means investor will choose this to reside. So will choose a higher return because they like it. So liquidity premium, which means that the further away the bond, you lock up my money. So let's say if I invest 30 years and lock up the money for 30 years, then there will be a liquidity premium. You have to pay me, then I cannot pull the money out. So that is the premium. If someone asks you, hey, it will be the same thing as bank deposit. If HSBC asks you to deposit like 2 months, the rate would be like maybe 1%. But if you are able to deposit 6 months or even 3 years, they will offer you a higher rate. Of course, the higher rate is to compensate the lockup period because they lock for 3 years. If you only lock it for 2 months, then there's not much use for that. So this is how they do it. HSBC will compensate, let's say, if you are able to lock up 30 years, let's say 20 years. Will they do it? Yeah, they will pay maybe 4% to you because they can actually use your money, 4% to lend other people at 8%. That's how they make the money, make the spread. The longer you can deposit, the more attractive the business that is, and they can actually lend it to someone else. So this is the liquidity premium. And for the expectation theory, which is the down below, is the about the time structure, and in the short run, it's it remain constant. And then there are actually two different slides here. Actually, when you have this forward rates are horizontal, it means a constant liquidity premium, which it's actually not necessarily the case. But if you have a liquidity premium higher, then you can have a upward sloping curve. So which means panel, not panel B, actually panel A is actually for one regular terms. You have the expectation premium, then the yield curve is going to this rate. But if you have a short term expectation theory going down, and then you have a long term liquidity premium like this, then you still maintain upward sloping yield curve. This one is flat out yield curve. And then again, the two theories, one is dropping short term expectation theory, and then the other one is the liquidity premium is decreasing. Then you have downward sloping yield curve. And then the other one is panel B. So we are actually in the panel C right here. The short-term expectation is decreasing. No one wants to know the future, and then liquidity is increasing. So imagine this. Imagine right now we are going into the world's end. For some reason, a big rock, a meteoroid is coming to hit Earth in the next 6 months. What do you think the yield curve will be? Do you think there will be a yield curve? No, the world is going to the end. Forget about this yield curve. There's no 30-year because we are not going to see what happened after 6 months. The yield curve will definitely chop down to like half year, and there will be chaos. But basically, I don't think anyone will do any trading at all. But still, some people will time it, will spend $1 to buy the entire Tesla, but everyone will try probably to say with the family. So think about when the world is going to end, this will actually short to even closer. There won't be any 10-year maturity or even 5-year maturity. So that is the so you can see there are different types of yield curve: normal yield curve, inverted yield curve, a steep yield curve, a flat yield curve, and a hump yield curve. And all these yield curve will explain to you what happened with the economy. Especially for the now it's going to inverted yield curve. The question is how inverted it is, and another question is when are we going to see a normal yield curve? So from inverted, we have to go through the flat before going to normal. This is how you can predict the market mood. Again, yield curves are good predictor for the business cycle. This is 310. The orange line is 310. This is a GDP growth. When it hits when the 310 is getting higher, then you see that's a big problem. That's a big problem. Gray line is the gray zone is actually the recession. So you can see the 310 is actually getting worse during the two wars, inflation, and then the tech bubble, and then the Gulf War in the 1990s. So all these. So you can see how crazy that is. But this is actually not up to date because right now the 310 is actually dropping to the negative zone. And this is standard deviation of monetary returns for treasury bonds. Even the treasury bonds were a standard deviation. It's not a lot. It's not a lot. So in the exam question, I hope you guys can answer something like this in the quiz. If I ask what is the bond standard deviation, and I hope the number will not be higher than the one with the stock. I will let you pick and choose. Let's say if stock standard deviation is 20%, what do you think the bond standard deviation will be? Don't say that it's going to be 20%. And then of course why it is lower standard deviation, because it's a lesser risk. So this is how you can think of. And this is again another plot. I hope I show you guys sufficient graphs so that you can see what happened with the market. So this is the 10-year treasury and then 90 treasury bills. With 10-year and 90 and 3 months, you can actually plot another spread. Yes, another spread, and that is different. If you plot it for you, the blue line, you can see when you have the recession that going forward. This is from, and remember this is like from 2 years ago. You see, this is the yield curve upward sloping. This is like 2 years ago. This is also 2 years ago. So you can see the US one, and this is comparing to the China one. You can see there's a difference. The China one, and by the way, the yield curve for China is always upward sloping. It never have an inverted yield curve. It is not man-made yield curve, but it is what it is. So you can see from that, you can actually claim that China is actually not in a recession, but the US and Europe zone is actually in a recession. So China bond market. So let's wrap up a little bit for fixed income. China, the middle one, back in 2010, it's only like, I don't know, 100 billion, not even 1 trillion, so 200 billion. But then 2021, you can see how it climbed up close to the US one. That's 2021. The problem for this particular bar is in 10 years, we have the same size as the US one. That's crazy. Yes, that is super crazy. This ultra crazy. But then 60% of that is from the real estate market. So that becomes a major problem. For the US, it's very diversified in by different sectors, but for China, it's different. It's the majority of that is actually real estate bond. And if the real estate markets suffer, the entire bond market suffers. So that's what happened in actually last year. And again, I show you more chart here. This is from Bloomberg. You can see the price. Again, everything is in fixing is easy because you can compare apples to apples. 100 is the key. You can see there are some countries. It's going up even higher than 100. That's just the pure demand supply. That's a 2-year maturity bond. It's trading a premium for Sweden and that. And for Asia Pacific, it's 104, even in Australia and China. So that's the price, and you can see the yield. Check out the yield. So check out the blue line here. If, by the way, this slide is actually 2 years ago. You tell me if you have all the monies you can invest, where do you want to put the yield to? Not definitely not in the negative zone, right? Definitely not in Europe. Then you consider Americans or Asia Pacific. But for Asia Pacific, do you want to invest in China? Yeah, yes and no. South Korea, probably not. New Zealand, too small a country. Then the only positive numbers that you can actually see is and also can trust, then it will be United States. All these guys here are emerging market. Canada is actually still good, but still too small country to invest. Brazil, Argentina, Mexico, no good, emerging market. And then in this case, Japan is negative. Australia probably is good, and New Zealand is too small. Australia and United States. This is why 2 years ago, when everyone squeezed into the US Treasuries, and when the rates spiked, and everyone lost. So that is the problem. And if you got able to invest in 10 years, the yield actually substantially changed. You see, if you invest in 2 years, you can only select the US market. If SVB select the US market to invest, they may have another different result, different ending. But they select a 10-year because it's actually even more attractive. The ones in the Euro, yes and no. Italy, you will get a problem. If you get 3.4 in the US, which one can you choose to outperform 3.4? You don't want to choose Brazil or Mexico. You don't want to choose, you're higher than Australia, and New Zealand is too small. Even China is too low. In this case, the only one you can choose is the United States. This is why SVB choose a lot of the securities in the US 10-year. Will other banks do the same thing? Yes. Hell yes. HSBC do the same thing? Yes. There is no options, no alternatives. Look at the entire world. Where can you put the money if you're fixed income? If you're an insurance company, where can you put the money? US 10-year. Liquid, safe, high yield. Yes, let's do that. Then you got 20% wiped out this year and last year. Interest rate rise too fast, from 0 to 5%. Now they have the bank run. That's the problem. So this is how it goes with the yield. I hope you guys have a mindset of how the yield and the risk and the return goes. And for the forward rate, so in fixed income, there are different products. So I talk about typical a simple bond, and then there will be something called zeros, and then there will be something called the MBS mortgage-backed securities, and then there will be some tranche that you heard of, and here it's another thing. It's called the forward contracts and future contracts. But let's focus on forwards. In this forwards, they focus on just the rate, and this is the same, exactly the same thing as we just talked about. The forward rate, spot rate, and also the short rate. That's the same thing. So I'm not going to go into here, but when you have a different rates here, the 7.01%, that's exactly the same number we saw before. We have fixed rate and doing the forward rate contract. So in terms of bond, not necessary, and not only you just doing the how should I say? I lend you the money, you borrow money. There's something called the forward rate contract. It's a long term, but then they base that on the interest rate difference. So that's a forward rate contract. So bond, long bond. So interest rate is very, very important to bond analysis. And of course, you probably will encounter a question. So let's say if you got a chance to go to an interview, asking, hey, how do you value a bond? And then you can plot the entire thing about the yield, about the interest rate, about the maturity. But at the end, everything boils down to credit rating. You think about this, you think about what happened in the last 2 weeks. Do I care about the yield? I show you the yield for Evergrande. 1,800%. Do you think the yield matters? No, it doesn't matter. The credit rating matters, not the ones from the S&P 500. No, I'm not talking about that. I'm talking about your view on the credit of the bond. So credit rating by yourself, not from the credit rating agencies. Credit rating agencies, S&P, Moody's, Fitch, they are extremely slow. I mean, much slower than you can expect. You believe that their rating sector is just useless. So I'm talking about your view on the credit. 2 weeks ago, you can sense there's some problem with the bond market, with the AT1 bond. The pricing is actually start dropping already for those days. Then you may be able to foresee something. If you're able to foresee something, can you speculate that, hey, why don't you just position yourself to do something? 2 weeks ago, seriously, there was a client, one of my major clients, that was on a Sunday. That was barely 2 weeks ago. She was actually asking me, hey, she was the CEO of a Hong Kong major company. She was asking me, hey, William, do you want to, should I, because I never managed her personal portfolio. I managed her another portfolio, but her personal portfolio has HSBC. As you guys probably know, by now, I hate that company. And I said, hey, no, just short it, and just sell it, because it has a lot of problem with the SVB, and there's no way HSBC can stand alone without being impacted. Impossible. The stock is already ran up by going to $60 to down to $55. And I told her, why don't you just unwind it? And then it took a week. It took a week for the stock to still keeping at 55. I said, hey, and I called her up and said, hey, did you sell your stock? And she said, yes, you sell half of it. Half of it will be a loss. I said, okay, yeah, well, maybe you should get her some time to sell it more, because it's getting crazy. And then it turns out 55 now is down to like 49 before. HSBC cannot escape the fate of Credit Suisse. So this is a problem of the credit of the forward looking. I hope you guys can see something from the fixed income market, so that you can apply that to your equity market, your stock market. So this is the entire report for fixed income session. Here can be a lot of calculations in fixed income. I'm not going to ask you to do that, but I hope you guys understand the concept. Concept is very important. So next week, when you go into the tutorial session Tuesday or Wednesday, listen carefully on what people will say, because she will say, she will focus on ICA. As I said, she will focus on the paper, and I ask her to tell you every single thing you need to know on the ICA. Nothing will be hidden. And you can ask a question, and after she spend like an hour with you, then will be the quiz, and then will be the ICA. So it is very, very transparent, and I'm not lying to you. Last time I have a final exam, open book, open notes, open internet, open everything, except the fact that you cannot speak to each other. Last year was like that. And I said, hey, I don't understand why we cannot do that. And I can actually do something like that, and we did it. So it was a open book, open notes, open PowerPoint. I let you to use 10 computers. Only thing is you cannot talk to your classmates. And it works out fine. I did my job, and everyone was happy. It's not they said it's not a hard exam, because I indeed cover everything in the tutorial session, but at the same time it's a fair exam. No one is able to cheat, because I let you guys to open. You can actually even go online, go to my PowerPoint slide and search for the answer. I let you do everything. But then still not everyone get a really like the top score, which is to my surprise. It's about the concept issue. All right, so we will finally I can catch up on catch up on fixed income. I will go over the option next time. All right, have a nice weekend. I will see you guys on Friday. Yes. Oh, you mean this ICA? Next ICA, yes. Again, the calculation is, I'm not going to ask you I'm not going to ask you to calculate the bond price. That is actually stupid. The calculation it will be very, very straightforward. My expectation is I don't want you guys to use a calculator. But if you want to use a calculator, it's fine. You bring a calculator, it will be just addition, subtraction, maybe some division, multiplication, but it will be very, very easy. You will know more on the Tuesday and Wednesday for that part. So what's that? Yes, concept. And I will reduce my words, the number of words that I will put out. If you don't understand my long paragraphs, then I will shorten it to so you don't need to read a lot. How about that? What kind of so this ICA will all be about fixed income. It will be about the yield curve, about the relationship price, price yield, and all that, all those important elements. So I want you guys to relax for the week, and so if you want to prepare for that, the best way to do is you just go over the slides. You don't need to study it. I don't want you to do that, but you try to grab the concept. That is important. All right. Okay, I will see you next week. Any other question? Let's go outside of the classroom.